In this video, I'm going to tell you the 4 steps to goal-based investment planning and then illustrate with an example. Our example will focus on retirement planning because it is the one thing you are all guaranteed to have in common, and it pays to start early. This is important for everyone, perhaps particularly for women, because many women live longer than men, earn less than men, spend years out of the workforce caring for children, and accumulate less retirement savings. I'm Rick Van Ness. You're watching the 10 Rules of Common Sense Investing, a video series about saving and investing to maximize lifelong happiness. These rules help you answer 2 questions: how much to save and how much risk to take. Some of our dreams need a little money. This list is where we begin. We need to have some idea of how much we need to save and how we will save that. There may be part of you rebelling already. Relax. Of course you don't know the future, but it will serve you to imagine one scenario. The enemy of a good plan is the search for a perfect plan. So make assumptions and then change them when you get better ideas or better information. Our goal is to enable these possibilities. Step 1 is to start with simple goals, dates, and costs. Expect your plan to change every year. That's okay. Keep it simple or you won't remember it. Write it down now, improve it later. Your goals are dreams with deadlines. Think in terms of how old you will be. That's the same as a date, but you're imagining it. It's more personal. Make a quick wild guess at how much money each goal will need. I promise you, that turns on your radar, and subconsciously you'll begin gathering information that will improve your initial guess. So don't worry about being way off. You know, just doing this simple exercise is the hardest part. It's not a workable plan yet, but it is a direction, and you may eventually get to where you want just by going in that direction. Step 2 is to improve the cost estimates. Whether your goal is to buy a house, remodel your kitchen, or plan a comfortable retirement, the place where all these planning steps differ the most is how to improve the dollar estimates. You probably don't need as much help with your other goals, which is another reason I've chosen our example to focus on retirement planning. Considerations for retiring include figuring out how much savings you'll require, when to start Social Security, and whether to use CDs, a lifetime annuity, stock index mutual funds, or a combination of these kind of things. Step 3 is to prioritize by needs, wants, and wishes. The idea here is to match safe investments for your essential needs and consider investment risk only for the wants and wishes that you could live without if risk rears its ugly head. Step 4 is to match each goal with investment risk. This will be the grand finale and easiest for me to show by our example. The challenge here is to turn retirement savings into monthly income for however long you might live, and avoid some of the other big financial risks ahead. Big risks are not saving enough, inflation, stock market volatility, outliving your money, and common investing mistakes because we're human. Let's dive in. We'll use an easy-to-follow example. His name is Ed. He was single his whole life and is now retiring at age 66. Every year since he was 25, he wrote this same goal and kept adjusting it every year for inflation. Back in 1980, it looked like this. Now it takes 3 times as much money to retire with the same standard of living. Always keep your plan updated in today's dollars. The total savings dollar goal is important to choose. It's often called your nest egg. Goal-based investment planning for retirement starts with an estimate of annual living expenses. Most people want to keep their lifestyle in retirement to be the same as they had just before retirement, and they can do that by replacing only a portion of their pre-retirement income. This replacement income is lower because you no longer need to save for retirement. Your tax rate might be lower. You may have paid off your mortgage. The kids may have moved out. You spend less related to your career, and you have more time to shop around for a good deal and more time to cook at home. I'll show you 2 methods to estimate the total savings that will be required. The primary sources for retirement income are Social Security, pension benefits, and accumulated savings. We need to estimate the amount of retirement living expenses that will need to come out of your savings. In the United States, your Social Security benefit is often most significant for low earners. For high earners, a larger portion will have to come from savings. A simple method for those with modest lifestyles is to multiply replacement income by 12. The idea here is to assume your Social Security benefit will cover about half of your retirement income needs. In our example, Ed used this approach because it was simple. Later in this video, you'll see how well it works out for him. He recently decides his replacement income should be about $65,000 a year and then grow with inflation. So his total savings in his nest egg needs to be 12 times that, or $780,000. Remember that number for our example, because he'll have to draw from that to supplement his Social Security income. And there are some important decisions ahead in steps 3 and 4. Now, some of you are going to need to save more. Well, who might that be? If you choose a higher standard of living, or if your Social Security benefit might be lower, or if you need to buffer stock market volatility. Moreover, some of you have other sources of income like a pension. So another very popular method to figure out what your nest egg needs to be is the 4% rule. You'll start with your replacement income, subtract income you'll get from Social Security and pensions, and come up with your annual draw from your savings. Your total savings nest egg should be 25 times your annual draw to finance 30 years of retirement. You get those extra years because it assumes you're invested 50% stocks and 50% bonds. This method might suggest you need a bigger nest egg. It would for Ed. Is one method better than the other? It depends. You'll get some insights as we keep working our example. Let's recap. Initially, we made our best guess at the dollar cost. Step 2 looked at 2 easy guidelines to improve it. We're not after precision here, just to get in the ballpark. The next 2 steps will look at how we should invest this money. Step 3 is to separate needs, wants, and wishes. Ed has met his retirement savings goal and would like to retire this year at age 66. To achieve a worry-free retirement, he now expands his one goal into 3: his essential needs, his wants, and his wishes. Here's a closer look at how his annual living expenses might break down. His essential needs are not optional. They add up to $40,000 a year. His wants are discretionary. He could live without these, but they're important to his quality of life. They're another $25,000 a year. If he had enough money, he has additional wishes as well. For step 4, we'll compare 3 strategies to match investment assets with each goal. Most important is to establish safe, guaranteed income sources for your essential needs that will need to last your lifetime. That's the needs below this red line. Since there is uncertainty about how long you will live, Social Security, pensions, and some commercial annuities are well suited for matching with this goal. This is the role of annuities. People that live short lives subsidize people that live long lives. Society comes out ahead because everyone is not oversaving for long life contingency. This frees up money for people to take trips or other spending that increases happiness. My example will illustrate this. Next, Ed considers 3 different ways to match investments with his goals. First, hedging inflation with Social Security and TIPS bonds. Second, delaying Social Security and buying a lifetime annuity. Last, using low-cost index funds instead of an annuity. Just for fun, do you want to take a guess at which of these 3 strategies will be best for Ed? To evaluate these strategies, Ed must consider them as generating streams of income for each year of his retirement, with income for his essential needs coming from one source and income matched with his wants coming from perhaps another source. Detaching this income from the stock market enables a worry-free retirement. Ed's goal is to create inflation-protected retirement income of $65,000 a year using Social Security and his savings. Ed's first potential strategy is to hedge inflation using both his Social Security benefit plus use inflation index bonds called TIPS bonds. He starts by looking up his Social Security benefit at mysocialsecurity.gov. It shows your monthly benefit for different start ages. Starting at age 66, Ed's benefit will be about 12 times this monthly amount, or about $30,000 this year, with an annual inflation adjustment. He receives the Social Security benefit for as long as he is alive. But so far, he's $10,000 shy of the red line, his annual bare essential needs, which are $40,000 a year. His savings could give him an additional $22,000 till he's age 100, but that doesn't cover half of his wants, so he sees that as an unhappy retirement. Alternatively, he could fully fund his budget for wants, but then he would run out at age 87, and he would have to hope to get into a desirable Medicaid facility, which he's not at all excited about. Ed thinks that Social Security benefit is looking better than ever. There's a huge benefit from delaying Social Security until age 70. In this example, it's an additional $10,000 a year. He'd get $40,000 for the rest of his life. And it includes a cost of living adjustment. For most people, this is an exceptionally good deal. In the second strategy, Ed still retires at age 66 and uses maturing bonds to fund the 4 years before his Social Security benefit starts at age 70, which will now be $40,000 and fully cover his essential needs. With the balance of his money, he plans to purchase an immediate income annuity, also at age 70. He looks up a free quote for an immediate income annuity to fully fund his wants for as long as he lives, keeping up with inflation with a 2% cost of living adjustment. Looks good. Again, he retires at age 66, uses his savings for 4 years to get the higher Social Security benefit, and will buy an annuity with a cost of living adjustment when he reaches 70 to cover all of his wants. In fact, he'll have $58,000 left over to use for his wishes. He's eliminated longevity risk, inflation risk, and market risk. Looks pretty good. All of his needs are covered, and he'll sleep well, never having to worry about stock or bond markets again. But he wishes he could be more generous, which maybe he could be if he didn't purchase the annuity. So for completeness, he considers whether he might rather be in stock mutual funds. He could allocate money to get his essential needs, then using the 4% rule for the rest of his nest egg would suggest that he could safely meet his wants for 30 years with a portfolio of stock and bond index funds. This would give him the best chance of additional funds if the market is strong, but also the greatest risk of shortfall if the market does badly. He'd especially be in a jam if the retirement years start with a sequence of bad returns. This isn't a good strategy for Ed, but everyone is different. Somebody very frugal with very few wants might prefer this, or somebody wealthy enough that they could bear the market risk. In this video, I've shown that it is easy to make a plan and improve it each year. It starts by putting your goals in writing. For our retirement planning example, we use guidelines to estimate annual living expenses and then calculate the total savings nest egg required for that retirement income. We prioritize to separate essential needs from those which we could live without. And finally, match investment risk with each goal. Don't worry if you don't feel like you can do all this yet. There's more to learn, and you'll become comfortable. I'm showing you the kind of thinking you'll be able to do. Keep watching this video series, learn how to take control of your finances, and live the life you want to live. The next video will look at saving. How do people save that much money? What important tricks make it easier? After that, learn about your most important decision, investment risk. See you in the next video.